They tried to stop it. They dumped 73 million ounces of paper silver in 360 seconds, and it still didn't work. The fortress wall they defended for 6 straight sessions broke. Tonight, the banks are not sleeping. The clearinghouses are running numbers. And tomorrow morning at exactly 10:15 a.m., something is going to happen in the silver market that hasn't been seen since March 2020. Either silver hits 88 or everything collapses. There's no middle ground, and the next 12 hours will decide which one. Welcome to Smart Fination. Now, before we go any further, if you have been here before, you already know what this channel is. If you are new here, think of us as that quiet, serious friend who never panics, but always calls you before something big happens. And we are calling you right now. To everyone watching, we have one small request. You know that subscribe button sitting right there? Think of it like this. You wouldn't let your most trusted financial advisor walk out the door without getting his number, would you? One tap. That is all. Consider it your insurance policy. And one more thing, drop a comment below and tell us where in the world are you watching this from tonight. Because the story we are about to tell you affects every city, every currency, every portfolio on this planet. All right, let us begin. It begins with a number, not a headline, not a rumor, not a prediction. A number, 8314. That was the price silver closed at on Monday, February 9th, 2026. And to most people scrolling through their phones that evening, it meant nothing. But to the people who understood what that number represented, it meant everything. To understand why 8314 matters, one must first understand what stood in front of it. For 6 consecutive trading sessions, a wall existed in the silver market. Not a physical wall, not something printed in any official document, but a wall that every serious market participant could see clearly in the data. That wall was 83s, or almost. Every single time silver approached that level over the past 2 weeks, something pushed it back down. Not slowly, not naturally, but immediately, aggressively, with precision. The kind of precision that does not come from ordinary selling. The kind of precision that comes from a coordinated strategy. Monday morning told the story with complete clarity. At exactly 9:30 a.m. Eastern Standard Time, the COMEX silver market opened at $82.91. 6 minutes later, at 9:36 a.m., the price had dropped to $80.34. That is a fall of 57 in 360 seconds. Now, here's where the serious observer must pause and ask a simple question. How much silver normally changes hands in 6 minutes of ordinary market activity? The answer is approximately 2,000 contracts. On Monday morning between 9:30 and 9:36 a.m., 14,783 contracts were dumped onto the market. To put that number into human terms, that is 915,000 ounces of paper silver sold in 6 minutes. That is not a pension fund rebalancing its portfolio. That is not a mining company hedging its production. That is a machine, an algorithm designed with one specific purpose: to create the appearance of weakness at the exact moment when the most retail stop losses were sitting below the market. The goal was simple: trigger panic, push price down, reload positions cheaper. It is a strategy as old as the markets themselves. But on Monday, something went wrong for the people running that strategy. Because by 3:47 p.m., with less than 15 minutes left in the trading session, they tried one final time. A last desperate algo dump attempted to pin silver's closing price at $8,287. It failed. Silver closed at 834 above the wall, above the fortress, above the line they had defended for 6 straight sessions. Now, here's what the business community must understand about this moment. When an institution defends a price level repeatedly, it is not doing so out of habit. It is doing so because something important sits on the other side of that level. In the case of silver in the 83 due wall, what sits on the other side is a cascade of forced position covering. There are entities in this market that are short silver, meaning they have placed large financial bets that silver's price will go down. When silver instead goes up and crosses key levels, those entities are legally and mechanically required to buy silver to cover their losses. And when they are forced to buy, the price goes higher. When the price goes higher, more short positions are triggered and the cycle accelerates into what market professionals call a short squeeze. The Monday close of 83.14 was not a victory. It was the beginning of a sequence. There is one final detail from Monday that cannot be ignored. The timestamped data pulled from the COMEX order book shows that in the final 13 minutes of trading, the buying pressure that lifted silver above 83 wars was not retail. The order sizes, the execution speed, the timing, it was institutional. Someone wanted silver to close above 83s or US dollars, and they had the resources to make sure it happened. The question that now sits over every serious market participant, his desk tonight, is not whether something is coming. The question is what form it will take, because Monday was not the event. Monday was the setup, and Tuesday is where the story gets written. Most people never read the fine print. And that is precisely how they get destroyed. There's a rule in financial markets that sits quietly in the background of every single trade ever executed. It does not make headlines. It is not discussed on mainstream financial television. Most retail investors have never heard its name. But tonight, that rule is the most important three characters in the entire global financial system. T plus 1, T plus 1. It sounds harmless, almost boring. It is neither. Here is what T plus 1 means in plain language. When a trader, a fund, or an institution executes a trade on a Monday, that trade must be settled by Tuesday. Settlement does not mean the price is agreed upon. Settlement means the actual exchange of money and contracts must be completed, finalized, closed. There is no extension. There's no negotiation. There's no calling the clearinghouse and asking for more time. The clock starts the moment the trade is executed. And on Monday, February 9th, 2026, an enormous number of trades were executed. Now consider the position of the institutions that spent Monday morning dumping 1483 contracts onto the silver market in 6 minutes. They sold contracts they did not own. This is called short selling. And in the paper silver market, it is perfectly legal. It happens every single day. Institutions borrow contracts, sell them at a high price, wait for the price to drop, buy them back cheaper, and pocket the difference. The entire strategy depends on one critical assumption, that the price goes down. On Monday, silver did not go down. Silver closed at $83 or $140. Above the wall, they spent 6 sessions defending. And now, because of T plus 1, every single one of those short positions opened on Monday must be resolved by Tuesday's close. They cannot wait, they cannot hope, they cannot extend. The clearinghouse does not care about their strategy. The clearinghouse only cares about settlement. But T plus 1 is only the first layer of Tuesday's pressure. The second layer sits at 10:15 a.m. Eastern Standard Time. This is the moment that serious market participants have circled on their calendars in red. This is COMEX options expiry. To understand why this matters, one must understand a concept called the gamma flip. When options contracts expire on the COMEX, the dealers who sold those options must adjust their hedging positions in real time. As silver's price moves above certain strike levels, those dealers are mathematically forced to buy more silver to stay neutral. The more silver rises, the more they must buy. The more they buy, the more silver rises. This is the gamma flip. And once it begins accelerating, it does not stop on its own. It feeds itself like a fire that generates its own oxygen. History has recorded this pattern before. In every major silver short squeeze since 1980, the same sequence has appeared. A key resistance level is broken late in a Monday session. Institutional short positions are left exposed overnight. T plus 1 settlement pressure collides with options expiry the following morning, and the market moves in any direction that erases weeks of carefully constructed positioning in a matter of hours. This is not coincidence. This is mechanics. Numbers do not have emotions. Rules do not negotiate. Settlement clocks do not pause for strategy meetings in Manhattan boardrooms. And here is the detail that should concern every serious business mind watching this story unfold. The entities that are short silver right now know all of this. They wrote the rules. They designed the system. They have navigated settlement pressure 1,000 times before, which means one of two things is true tonight. Either they have a plan to manage what is coming tomorrow morning, or they are sitting in offices right now running numbers that are not working out in their favor. The markets will not lie about which one it is, because at 9:30 a.m. tomorrow, the opening print will tell the entire story in one number in 1 second. There's a clock running tonight. It does not pause, it does not reset, and every serious market participant on this planet is watching it. Most people think the financial markets operate on a simple schedule. They open, they close, they rest. But the silver market does not rest. It breathes continuously across 3 cities, 3 time zones, 3 completely different institutional cultures that together form a single unbroken chain of price discovery that runs 24 hours a day. And tonight, that chain is under extraordinary tension. Because what happens in each of those 3 cities tomorrow builds on what happened before it. Like dominoes standing in a very specific order, the first domino falls at 3 a.m. Eastern Standard Time. This is when the London market opens. And London is not simply another trading session. London is where the majority of the world's physical silver pricing is established. The London Bullion Market Association, the LBMA, sets benchmark prices that ripple across every contract, every fund, every institutional position on Earth. When London opens tomorrow morning, it will be looking at Monday's closing print of 83 Mount Fortin Tor. It will be calculating the overnight positioning from Asian markets, and it will be making a decision. That decision will not be announced, it will not be published in a press release, it will simply appear in the price action between 3 a.m. and 4:30 a.m. If London opens and silver holds above 830 arms, the message is clear. The institutional community has accepted Monday's close as legitimate. The wall is gone, and New York will wake up to a very different battlefield than the one that existed on Monday morning. But if London opens and silver is immediately walked back below 83 scars, then a different conversation is happening in those offices. It means the entities that failed to defend the wall on Monday are trying one final time in the quietest hours of the night when the fewest eyes are watching. This is why serious market participants do not sleep through the London Open during high-pressure settlement weeks. The 3U AM print is not noise. It is the first piece of evidence for what New York will do at 9:30. The second domino falls at 9:30 a.m. Eastern Standard Time. New York wakes up, and New York does not ease into the morning. The COMEX opening print at 9:30 a.m. will be the single most watched number in the global commodities market tomorrow, because that opening print will immediately reveal the positioning of American institutional players, who spent all of Monday night and all of the London session calculating their exposure. Here's what the data says about similar historical setups. When silver breaks a multi-session resistance level on a Monday close and London holds that break overnight, the New York Open has historically seen an initial move of between 1.2%, 2%, and 2.7% in the first 11 minutes of trading on a silver price, sitting near 83.14. A 2.7% move in 11 minutes puts the price at 85.38. That is not the target. That is just the opening move. The third domino, and the most consequential one, falls at 10:15 a.m. Eastern Standard Time. This is COMEX options expiry. This is where the gamma flip mechanism described in the previous chapter of this story meets real money in real time with real consequences. At 10:15 a.m. tomorrow, dealers across the COMEX will begin their final hedging adjustments as expiring options contracts are settled. If silver is trading above the key gamma flip level at that moment, those dealers will be forced to buy. Not because they want to, not because their analysis says silver is a good investment, but because the mathematics of their own hedging models will leave them no choice. And when that forced buying begins, the question is no longer whether silver moves higher. The question becomes how fast. Two scenarios now sit on the table. They are not equal. They are not moderate. There's no comfortable middle ground between them. Scenario A, London holds above $83. New York opens strong. The 10:15 gamma flip triggers forced institutional buying. Short positions covered under T+1 pressure add fuel to the move. Silver breaks through $85.86 or $87, and before the lunch hour in New York, the number $88 appears on screens across every trading floor on Earth. Scenario B, it is darker, and it must be spoken clearly because serious decision makers do not benefit from comfortable narratives. If the entities that have been defending 83 pondered Star Wars for 6 sessions choose to deploy a coordinated force majeure event at the 10:15 a.m. expiry window, the move goes in the opposite direction. Not gradually, violently. A cascade of liquidations. Leveraged long positions wiped in minutes. Silver does not drift to $78. It falls to $78. In the same way, a building does not slowly lean over, it collapses. This is the cliff edge that was described at the beginning of the story. And now standing here at the timeline, one can see exactly where the edge is. It is not at the Monday close. It is not at the London Open. It is not at the New York Bell. The edge is at 10:15 a.m. tomorrow, 11 hours and counting. The clock is still running. Every story has a moment where information stops and decision begins. This is that moment. There is a particular kind of person who watches markets the way a surgeon watches a patient on the operating table. Not with excitement, not with fear, with precision. They do not celebrate when the numbers move in their favor. They do not panic when the numbers move against them. They simply observe, calculate, and act according to a framework that was built long before the volatility arrived. Because here's the truth that separates serious market participants from everyone else. Volatility is not the enemy. Unpreparedness is. In the next 12 hours, we'll sort every participant in the silver market into one of two categories: those who had a framework and those who wish they did. The first principle of navigating a gamma flip volatility event is one that sounds almost insultingly simple. Know your number before the market opens. Not during, not after, before. Every serious participant sitting in front of a screen tomorrow morning should have already answered 3 questions tonight. At what price does my position become a risk I can no longer manage? At what price does the thesis of this trade become invalid? And at what price do I take profit even if the market appears to be going higher? These are not emotional questions. They are engineering questions. A bridge builder does not decide how much weight a bridge can hold while trucks are crossing it. He decides before the first truck arrives tomorrow morning at 9:30 a.m., the trucks will be crossing. The numbers must be decided tonight. The second principle is position sizing. And in a gamma flip environment, this principle carries more weight than almost any other decision a market participant can make. Here is what the historical data shows about COMEX, options, expiry events, and high-tension settlement weeks. The average price range from the low to the high on expiry days that follow multi-session resistance breaks is 4.3%. On a silver price near $8.34, that is a swing of nearly $360 from bottom to top in a single session. For a participant holding leverage positions, a $360 swing is not a fluctuation. It is a portfolio-defining event. This means that anyone approaching tomorrow's session with position sizes calibrated for normal market conditions is walking into an extraordinary environment with ordinary equipment. The serious participant reduces size before the event, not because they lack conviction, but because smaller position sizes allow them to stay in the trade when the inevitable violent shakeout attempts to remove them from it. Survival in the first hour of tomorrow's session is more valuable than any entry price. The third principle concerns the 3 timestamps that will define tomorrow's session. Each one requires a different response. At 3 hours a.m., the London Open, the task is observation only. No decisions, no adjustments. Simply watch whether silver holds above 80 or is walked below it. That single data point will recalibrate the probability of scenario A versus scenario B before New York ever wakes up. At 9:30 a.m., the New York Open, the task is confirmation. If London held the level and New York opens with strength above 83.50, the setup is intact. The short squeeze mechanics are loading. But this is still not the moment to increase exposure. This is the moment to confirm that the thesis is playing out as expected. At 10:15 a.m., COMEX options expiry. The task becomes execution. This is where the framework that was built the night before meets the reality of the market. The gamma flip either triggers, or it does not. Silver either accelerates toward 800 EOTIS, or the force majeure scenario begins its cascade toward $78. At this moment, the serious participant does not improvise. They execute the plan they already made calmly, precisely, without hesitation. Now, here is what this story means for the broader business community. Because this is not only a story about silver. Silver has historically functioned as one of the most sensitive indicators of institutional stress in the global financial system. When paper silver markets experience the kind of coordinated pressure that Monday's session documented, it rarely stays contained to silver alone. What happens in the COMEX silver pit tomorrow morning is a signal. A signal about liquidity, about institutional confidence, about the degree of stress sitting beneath the surface of markets that appear to the casual observer completely calm. The entrepreneur watching the story unfold should ask one question that has nothing to do with silver contracts or gamma flips. What does it mean for my business, my cash reserves, my supply chain, if institutional stress in commodity markets accelerates into something larger over the next 30 to 90 days? Because the banks that defended 83s or for 6 sessions are the same banks that extend credit lines, the same banks that finance inventory, the same banks that process payroll for companies employing millions of people. When those institutions are under settlement pressure, the effects do not stay on trading floors. They travel quietly at first, then all at once. This is what the Smart Fination has always believed. That the most important financial information is never delivered with fanfare. It arrives in timestamps, in order book data, and settlement rules that nobody reads until it is too late. Monday gave the world a timestamp. $8,314 at $4 p.m. on February 9th, 2026. Tomorrow will give the world an answer. Either silver makes its comeback and the number 88 becomes real before lunch, or the system pushes back harder than it has pushed in years. Either way, the serious observer will not be surprised because they read the fine print. They watched the clock and they built their framework before the truck started crossing. The story has been told. The clock is still running. The decision is yours.